Let's get started. This is a great panel. This is always a staple of this event when we do it in DC and on the West Coast. You know, financial disclosure and accounting fraud is kind of the bread and butter of the SEC enforcement program in a lot of ways, and a really important topic at this conference every year. Let me start by introducing our panel, starting with Rachel Copenhaver, a partner at VedderPrice in Chicago. Her practice focuses on representing defendants in government investigations, conducting internal investigations, counseling clients during regulatory examinations, and defending suits alleging director and officer liability. Welcome, Rachel. Next to her is Jennifer Lee, a partner at Jenner & Block. Until just a few months ago, Jennifer was an assistant director in the SEC's Division of Enforcement in San Francisco, where she served for 12 years and was a veteran of our West Coast conference on many occasions. Welcome, Jennifer. It's great to see you. Next to her is McKinley. She's an assistant director at the U.S. Securities and Exchange Commission and based in the SEC's Chicago office, where she has served for over 24 years. Welcome, Ann. Thank you for joining us. Next to her is Pravin Rao, a partner at Perkins, Coie in Chicago. Pravin previously served as an AUSA in the Northern District of Illinois and also as a branch chief in the SEC's Division of Enforcement. And finally, our moderator, Steve Richards, is a senior managing director at Ankura Consulting Group in Washington, D.C. Steve has over 20 years of experience involving internal and forensic accounting investigations and analysis. And Steve has previously served as a senior advisor to the Director of Enforcement and Investigations at the PCAOB, as well as assistant chief accountant at the SEC. Steve, great to see you, and take it away.
Excellent. Thank you, Bruce. So for all of you in the room, just realize you get double credit for your CLE because this is going to be that insightful a panel. The other thing is, if you guys see David Woodcock, he gave me $20 and told me that the next panel has ethics credit, but I'm not sure that's true. So just mind to check with Dave. So we're going to do something a little different here because what we try to do in any of these panels is we're all practitioners. Right, and so the chance to have time with the commission staff and to talk about issues that we deal with every day, one approach a lot of times we do is just ask the staff and say, hey, what's your priorities? We took a little different approach here to try to make sure we got a dialogue going. And so I'm real sure that this panel is going to kick ass because we got a bunch of great people on it who've practiced in a lot of different circumstances. Many of us have been at the commission, nearly all of us. And we deal with this every day. So we went through in some of our planning calls to say, what's most interesting to you? And so the hope is that we will cover at least some of those topics over the next 45 minutes that would be most interest to you guys. So we're going to start off with materiality, and we're going to move through some other things. But I'd like to start with Ann, with you, on materiality is, a lot of times when we're dealing with these questions in front of OCA or an enforcement context, sometimes it feels like everything's material. Is anything ever not material?
I think that's fair to say. I think, I mean, really we do, and I'm probably going to sound like a broken record, but we do assess everything on a case-by-case basis, and you have to look at the particular facts and circumstances of every particular case. And, misstatements 5% or above, probably going to be material. If it's something that you speak about on a regular basis and use in every 8K that you file on behalf of the company. That may be material too, even if it doesn't rise to the 5% mark. So, I think the quantitative and the qualitative factors are all part of the story, but it is a story, and it's going to depend on the individual facts of that particular case.
And what I think is interesting is in some of the cases that have come out this fiscal year, that there seems to be less of a focus on what we would see as being the quantitative factors, so stock price decline, investor harm, just even shifting away from revenue or customers, things like that. And when you couple that with some of the other data points, so the chief, for the accountants in the room, the chief accountant's statement earlier this year, where he basically said, once you cross the threshold of something that's quantitatively large, it's just going to be hard to get away from that, even if the qualitative factors go the other way. I also think about the new cyber rules that say there's no quantifiable trigger for when something is material. It does seem like it's really the position of enforcement now that anything that a company puts out there is pretty much fair game in terms of materiality, even if the other quantifiable factors are not there. What do you think about that? Are you going to tell me facts and circumstances?
I'm not gonna promise I won't say it again. No, I think, it depends on that particular case though, because if you look at something that, okay, in one case, that is a huge point for a particular company, yeah, it's gonna be material for that company. But you look at the same thing in another company, it's something that no investor ever considers, it's not part of the mix, then it may not be. So, we are not bringing cases just to bring cases. We're not in that business. We've never been in that business. We have so much work. We have more than we can possibly do. So if there's nothing there, we'll close it and move on. And I think that's been the case my entire career at the commission, and I don't think that's changed.
Anybody want to add anything to that? I have one question.
Sorry, I didn't mean to shut it down.
No. I have one question about that too, because a lot of times, like when you look at you, Jennifer, you referred to the chief accountant's statement, and they talk about a lot of things in there as sort of inherent bias and relative to your role. How does the commission staff think about? And I'm going to say something I don't mean. I have tremendous respect for the staff, former member myself, but when you have a staff member who's been there for 30 years, right, and hasn't been out making these decisions at an issuer, right? And the issuer is looking at it from the interlocking responsibilities of the audit committee, the external auditor, everywhere else, everybody reaches the conclusion it's immaterial, but yet the staff turns around and says, no, it is material. How is a way we should be thinking about advising our clients in those situations where it's in that gray, if there's anything that the staff would be able to provide some context for us?
I'm always willing to listen. So if anybody wants to talk to me about something, I have an open ear and would be happy to consider it. Now, I'm going to look at other factors. I'm also going to look at what we've done in other cases and try to make sure that we're not treating one company because they have former staff as counsel differently than another company who didn't come in that way. But I get your point on bias, but we really have no skin in the game. And if that's something that you've all looked at and you have other experts who are backing you up, provide that information to us. Let me look at it and consider it.
Yeah, no, I appreciate that. Maybe let's shift to Rachel. We're going to talk a little about internal controls as an accountant, near and dear to my heart. The commission's taken some very aggressive stance recently on internal control cases, including bringing some charges outside of Section 13 in those kinds of cases, which has historically been unusual. What are your thoughts about the commission's aggressive stance here when you're advising your clients?
Sure. So I think internal controls obviously are always in the mix, right? And so I think thinking about the ways that those have gotten some traction over the course of the past fiscal year or so with the SEC. You got your typical they come up in the context of revenue recognition cases. You can fold in, maybe you have 10B, maybe you have 17A involved, but there have also been some recent cases involving internal control deficiencies, remediation of material weaknesses that are standalone, exclusively internal controls cases. So I think as we kind of have those conversations with our clients, realizing that kind of everything appears to be on the table, and certainly there have been a lot of interesting approaches to remedies. I think, for example, the Plug Power case came out somewhat recently. It had to do with material weakness remediation, and as part of that, there was an initial civil penalty that was imposed, but kind of taking an interesting spin on a springing independence compliance consultant and saying, well, you have a year to remediate these material weaknesses, and if you still don't do that, and you don't have management coming in and providing something in writing that these material weaknesses have in fact been cleared in management's view, then there was, I think, an additional $5 million civil penalty. So they're certainly kind of putting some traction behind making sure that if you are a company that you're actually putting in the effort, and maybe you don't have an independence compliance consultant, but there's certainly an opportunity that if you can't do it on your own, there's going to be some repercussion as a result of that.
I definitely feel like there's ratcheting up because last year I'm sure all of you followed the cases from last year, but there were a slew of cases that were signature-based fraud, negligence-based fraud, all in the context of restatements. And it was pretty rich in terms of the message that enforcement was trying to get out there. I think this year, it's also rich, but it's exactly what you're saying. It's almost taking it to the next level of saying, now we're going to bring these standalone internal controls cases. And when you look at the penalties assessed in those cases versus what was assessed last year for arguably higher and more egregious conduct, they're still in the same range, if not higher. So I do think enforcement, I'd be curious about your views on it. I do think that they're trying to really signal and reinforce the idea of you have to have a culture of compliance. Controls is just going to be something that enforcement, whereas previously they might have said these are broken windows, now they're doing something about it.
No, I'd agree with that. I mean, internal controls are the first line of defense. If you don't have strong internal controls, you're not going to have prevention. And so, and if there's a lapse, there are a lot of different reasons maybe behind a lapse, but I'm going to look at all of them. And it comes down to, if you don't have a culture of compliance, then, what else is going on at the company? And there are going to be likely problems that we'll find. So, no, I agree. I mean, I think the message that we do try to send, and I didn't give the disclaimer at the beginning of our remarks, so I will do it now. I'm assuming everybody assumes, but let me just make sure. Because everything that I'm saying, while I'm saying it in my official capacity as an assistant director in the Division of Enforcement, does not necessarily reflect the views of the commission, the commissioners, or anyone else on the SEC staff. Okay, well, with that out of the way, I can give my opinion. But no, I mean, I really do think that when we find that someone does not have any culture of compliance, that their internal controls lapse, that they allowed them to go on for years and years and years, then that's something that is not going to be remedied on its own, likely. And so, some of the creative solutions, and I've done a springing internal compliance consultant before as well, something that will incentivize companies to take it seriously. Maybe we'll send a good message that this is something that's important, because it really does work when it's working.
But I do wonder, and I want to go back to materiality and internal controls, and a theme we have here, and I think what we've seen in the conference thus far, the SEC is getting more aggressive, sanctions are getting bigger, they're expanding into other areas. But I really do wonder, when you talk about materiality and even internal controls, or even other ways for enforcement, where it's an area that's new or it's cutting edge. You use cyber, crypto. Somebody's got to be the first one who takes the hit. So when something may not really have been considered material, even if you say facts and circumstance, I wonder, how do you approach the SEC and say, look, we really tried our best here, if you represent a company or individuals in making decisions, but this was not really well defined whether it was material or not, even by the quantitative or qualitative standards. And then internal controls. We had controls in place we thought would make sense, but what I've heard and from numbers in our defense bar, the SEC sort of takes the position, well, somebody's got to be the first one, and your client's it, and that is a difficult thing, one, to explain to your client, and difficult to formulate a strategy on how to anticipate that, especially in areas that are just still undeveloped, whether it's materiality or internal controls. Sometimes the perception is the SEC says, boop, we want to set a precedent, and then 3 years from now the precedent's going to change. I don't think I got a question.
I'm trying to see if there was a question.
No, I just want to give a point of view from the defense side of the bar.
Well, one last point on that too is, and again, we're going back to some of the statements the chief accountant's made. Just this past month, he made a statement when he was talking about the management's assessment of internal controls as well as the auditor's assessment. It feels like what is an internal control continues to expand. Right? So if you go way back to the United case where it was budgeting controls, not financial reporting controls, sort of where are the edges of that? It just feels like what is defined now as an internal control continues to be things that maybe second degree from the financial statements.
I guess my point on that would really be more companies change, companies' priorities change, the way they go about doing their business changes, and if the SEC were to stick to what was originally around, when the 33 and the 34 Acts were enacted, we'd be dinosaurs and we wouldn't even be speaking the same language. So, I think as companies adapt, we also have to adapt, and it's not probably definable for a long-term point. It's really what is going on right now, and we're trying to stay up with the times.
Excellent.
And Pravin, I want to circle back to your question of what does it mean to be a first of its kind case? Because I personally brought one of those, the Yahoo cyber. At that point, it was not clear at all, just should the commission penalize an issuer for failing to disclose a data breach? And I think, just for my time at the commission, I think when there is a first of its kind of case, people think very carefully about, well, this is going to be a message case, and the facts better be egregious. It cannot be something that is just this, on the edge, on the continuum, where it's not really clear just why is this conduct even being penalized by the SEC. So I do think people think about that. But you tell me if I'm wrong.
No, I agree completely. That is something we think very long and hard about, and engage in lots and lots and lots of discussion. And it's not just enforcement involved in those discussions too. I mean, I think that's the other thing that everyone needs to know. It's not like enforcement goes off and we go to the races and it's just us. We do consult with all of the policy divisions. Everybody gets to weigh in on whether we are, in line or completely out of step.
Excellent. Well, one of the other things we talked about, and it's been talked about a few times during today's sessions, is cooperation. And so I think one of the things that all practitioners struggle with is, well, when I'm advising our clients, to be in a position and posture by which to maximize cooperation with the commission staff. Sometimes that's difficult to understand, especially with whistleblowers in the background and other things for consideration. Maybe we'll start with you, Pravin. What are your thoughts when you're talking to your clients early in that investigation, early in that action, around cooperation with the staff?
It's never too early to start thinking about it, especially if you've identified issues with your client. But it's like the old adage, cooperation credit. From the SEC's perspective, they appear to they know it when they see it. But I'm not sure the rest of us have that insight. Some of the pronouncements by the current SEC enforcement director is it should not be a gotcha process. You shouldn't go in, and if you self-disclose or self-report, that shouldn't start immediately this investigation where you end up worse than where you started off. But it's still a black box. And especially for the topics that we're talking about, financial disclosure and accounting, as the SEC said, I think you stated, it's the bedrock of the SEC. So, but I think that when we talk about increased sanctions, and that's what companies look at, how does that impact their bottom line? The SEC's perspective, and this is my opinion, not the opinion of my law firm, but it is that the pain has to be more than the gain. So the biggest thing that I always hear is how much we got to pay? If I go self-disclose and tell this to the SEC, what's the bottom line? And penalties are a big part of cooperation credit. And what I think it's worth saying is that that's part of it. But people forget about the dollar amount. They will look at the charges and the factual basis and what's in the OIP for a long time to come. So, and one of the biggest portions, if you look through various SEC settlements, that cooperation section, and maybe 2 lines and maybe 3 lines, you may get 5 or 6 bullet points. That's something that the company can point to and say, we did cooperate. And that is worth, even if you pay a $50 million penalty right now and then write it off and do whatever you got to do with it, that is worth down the road. The one thing to think about, though, the bar appears to be raising to get that cooperation credit. But there are 2 recent cases, Black & Decker and the View Inc., where it was 0 penalty. And if you look at the string of things that those 2 companies did, yeah, they did self-disclose. And the SEC noted, though, but boy, they did a whole bunch more. They shared the facts of their investigation. They shared details what their outside consultant told them. They did detailed financial analysis. And those of you who practice in our area, they literally responded to every subpoena, every inquiry, didn't even require subpoenas, made witnesses available. What I tell clients is, especially the corporate clients, cooperation credit, trying to get it, doesn't necessarily mean the investigation's easier. In fact, you may actually have to do more work, but the end result should be a smaller dollar amount, but it absolutely positively, very likely will not be 0. Because once again, if there's gain on your part, there has to be pain. So It is a dynamic, and then you have to balance also the negatives of telling the SEC. Because if you go to the SEC too early, you are besieged with subpoenas or requests, and you really cannot get your investigation done. And especially right now, that's important also to marshal the facts.
I think in a restatement case, I think it'd be rare, just talking about the size of the penalty, I think it'd be really rare to get, no matter how good your cooperation is, all the way down to a 0 penalty, just given that there's so many other factors that the commission has to think about, including deterrence. And usually if you have a restatement, it's probably some huge problem that they're going to need to say we need to do something. So I think that's just one observation I have. And then the second, I think is, to the extent that it's just some reduced sanction, I think some of the criticism I've heard is, well, it's not like the sentencing guidelines where but for this conduct, you would have gotten X sanction, right? So I think it's very hard for people to really tell what's the monetization of my cooperation credit. When you're looking at the restatement cases, let's say from the last year, from the last 2 years, I mean, no matter how good of a job you do, you're probably still going to have a $10 million plus penalty. That's just my estimation.
And I think just to chime in the defense bar, I think the point that Pravin made when we work with our clients, I think it's an education process in terms of being able to describe what cooperation means, what it includes, and what are the actual tangible benefits beyond just a civil monetary penalty. And so I think when we're talking about restatement internal controls cases, and so a big part of the C-board factors is, of course, also remediation. And so being able to be transparent and open and talk about all of the prompt and comprehensive remediation that your corporate clients has gone through holds a lot of sway, I think. And when you're having these conversations with the SEC, when you're thinking about, well, whether or not, as part of a remedy, whether or not an independent compliance consultant is on the table, right? If you're able to show that in addition to cooperation, we also had beyond meaningful cooperation, we had significant remediation that we were able to handle on our own. We get it. We have a culture of compliance. We have all of these enhancements that we're pursuing and going to continue to pursue. That's also a benefit of part of the whole cooperation C-board aspects of it as well that I just want to highlight since we're talking on restatement.
I think that's a great point. I mean, from my perspective, my previous perspective when I was with you, I think remediation is the greatest place where a company can really just gain significant cooperation credit, because it's the place where you can say, look at all these amazing things that we did once the misconduct was revealed. Whereas on cooperation, just meaning responding to inquiries, things like that, like everybody knows document protections take a million years, right? Like to get your witnesses ready, et cetera. So there's not really much you can do by way of really fronting facts to the staff in a way that's really going to get you, I hate to say most bang for your buck, but that's what I was thinking.
Yeah, well, I want to go back around something Pravin started with, is the timing of when you reach out to the staff. Too early, you can create a different set of problems. Too late, you don't have a chance at earning cooperation. And you guys' experience in representing your clients, like what are some of the points that you think about as to when you do that?
Part of it, the too early, sometimes you try to get to the SEC before something goes public. If you have a cyber breach, it's probably going to go public pretty quickly. One, if you're a public company, you got to disclose it. So you might as well go to the SEC right away, right? Because they're going to find out within days, and you can start that ball rolling. In other instances, and which is in most instances, it probably is better to wait until you've marshaled enough facts to see how bad it is. Because part of what the SEC also looks at when you come in with self-disclosure or self-reporting, that you've identified the issues. And the danger of just walking in and said, oh, we have issue with Division X, or we have this issue with these sets of books or these sort of finances, because then the SEC starts a very broad investigation, because you haven't told them what specifically the issues are and narrowed it down. So it is one way to sort of temper it. And the biggest advantage, I think, of cooperation beyond the end result is you get insight and dialogue into what the SEC is doing and thinking all along the way. If you do not cooperate at all and you just wait for the subpoenas, and we've all been in that situation, produce the millions of pages of documents, wait for the next subpoena, tee up the 10, 20 people for testimony, you're just playing sort of whack-a-mole the whole time. When you are cooperating, there is more of a dialogue. And I guess my final point is I do take Ann's point, and I do believe, having been at the SEC many years ago, that there is some internal consideration, thoughtful analysis. The SEC just doesn't say, like, we're going to do $5 million penalty and go pound sand. But the difference is, the difference is,
You should start saying that now.
Go pound sand.
Yeah, the difference is, as counsel, we may engage with the staff. We usually don't let our clients do that, so they're one step removed. And then there really are no guidelines, and Jennifer said it, the U.S. sentencing guidelines, for cooperation granted, generally what your corporate client may get. With the SEC, you just have to take a leap of faith and go back to your client and say, boy, there has been some really great internal thoughts and discussions at the SEC before they came up with that number. And your client looks at you and says, okay, what's the metric that I'm should be looking at? And then you can point to all the other comps. But oftentimes we get a number, or we get a charge, or we get languages, or we other stuff. It doesn't tie to anything. You can put the prettiest chart out there, and then you put your client and where they ended up, and you're like, how did I end up there? So it is tough.
This would be the one subject we haven't heard from Ann.
No, and I've been listening. I think the biggest issue that I see in investigations is someone responding to subpoenas and bringing their people in when we ask them to, and then coming at the end and saying, we cooperated so much, what are we going to get for it? And we still did a complete investigation. We had to pull every single fact out from every document and every single witness, and that's not cooperation. That's not obstruction, but it's not cooperation. Instead, cooperation has to be meaningful. It has to, and I'm, I don't want to use I know it when I see it, but it has to be more than just responding when we ask you for something and providing the things that we ask for. I think Jen's point was a really good one, that self-policing, self-reporting, those are huge, because if you are doing that, then you can demonstrate to us that you actually get it, and that you're not just trying to put a Band-Aid on something, you really are trying to fix it and make sure it doesn't happen again. I think we talk an awful lot, and I know Grabir gave a speech pretty recently on cooperation, but I think remediation is probably one of the biggest ones. I think provide us with detailed analyses. Don't just produce the documents, but help save us some time and effort that we don't have to bring in 20 witnesses to figure out a point. Help us by cutting to the chase and telling us these are the two people that you really should talk to, and these are the documents that we think you should look at.
So Ann, I feel like we see that in press releases where, in the cooperation part, it just says something like, the company has substantially assisted the staff by helping it cut down time by doing whatever, insert whatever thing. From your perspective, do you think it's helpful for counsel to reach out to you to say, okay, I've now given you the set of binders. I've now identified these 5 witnesses. How helpful is that to you? How are we doing by way of cooperation? Do you like having those conversations? Or do you tolerate them?
I definitely tolerate them. I'm happy to have the conversation. Some of the times when it's asked, I can't say anything. It's still ongoing. There's still more work to be done. So I may not be able to give you the answer that you're asking me for, but I don't mind getting the question. And I think, knowing that counsel is thinking about it throughout the investigation instead of just coming in at the end and saying, okay, we cooperated, where's our credit? We want the line in the order. I'm happy to have that conversation.
Should I tell you to blink twice if I'm doing a good job?
Sorry, not going to do that.
But I think to Jen's point, I think the press releases or even some of the OIPs have had some additional language beyond some of the clauses that we've seen in past years. So I think in the defense part, that gives us information that we can then take to our clients and say, cooperation isn't just satisfying a legal requirement. Cooperation is here. Here's a list of things that are tangible things that we can incorporate, and we can work with our clients and make a decision as to whether or not that's something that we're going to be able to do and willing to do.
And I think, purposefully, we don't put a list out because in each case, there could be different things that would be meaningful cooperation that maybe in another case may not, equate to that because it's not as important in that particular case. So I think, that's purposeful. But we've been, over the last few years, trying to do a better job of saying so. When someone really cooperates, like giving them that credit, not just with a line in the OIP, but if there's a press release, putting it in the press release. If there's something else that we can say about it, I think we've been trying to do that.
Can you envision a circumstance in which the commission says, okay, we're actually going to do an NPA or a DPA, or even just a total pass? Because I know there have been some cases, but they're pretty few and far between. And when you think about Ralph Lauren, which is the one NPA, it's pretty unique in the sense that it's an FCPA case. The SEC probably couldn't bring it anyways if the company didn't settle, right? So I just wonder, from your perspective, are there things that you think about in terms of just how can a company get no charges or even reduce sanctions?
We do think about it and we talk about it. I mean, it's definitely a topic that comes up, but it has to be the right case. And after something completely blew up, no, that's probably not going to be the appropriate case. But something where, I'm kind of trying to come up with something on the spot, but something where, maybe there's an industry-wide practice and someone comes to us, and maybe that would be a situation where I could see that coming up in the future. But no, I think they're few and far between for a reason, because it is an extraordinary remedy.
Excellent. Now, changing gears a little bit, and again, as the only accountant on the panel, in my notes to the team here, I wrote, the most dangerous job in U.S. capital markets is being an auditor. So just on that vein, with the PCOB having increased both the number and focus on their enforcement program, as well as the commission staff over the last couple of years, it feels like there's a lot of aggressive action being taken around gatekeepers from a standpoint of accountability. And maybe we'll start with you this time, if you can give us some context and perspective as to how the commission's thinking about that role and how it's evolved over the last few years.
Sure. No, I mean, we look at individuals in every case, because a company, broker-dealer, and investment advisor, they act through people. They don't act on their own. And so we have to look at people. And sometimes the gatekeepers are the people who had, all of the knowledge, all of the ability, and didn't act. But I think the focus of gatekeepers really isn't picking on them, and it's like trying to charge them. I think the focus is much more empower them to do their jobs well, give them the tools so that they can do that. And then, but when they lapse and they don't do that job, then, they are the first line of defense against misconduct. So if they just fall down on the job, I guess from my perspective, I feel like we have to do something, because otherwise, then there are others that are going to fall down on the job, and and it's just going to spiral, and then we have lots of gatekeepers that have no power and no no ability. So I guess from my perspective, it's not. I don't feel like we're targeting. And I hate, we don't use that word at the SEC, so that's certainly not. But that's not what we're trying to do. Instead, it's really, when they do a really bad job, we kind of need to make an example so that it doesn't happen again.
I think it's also consistent with just the discussion about controls. Just when is it too early for the SEC to be involved? They would also be criticized, would also be criticized if they come too late to the party, right? If there's already been this huge fraud, and then there's this question of, well, should the SEC have been looking at the controls of the auditor sooner? So I think it's a tough balance to strike, because it's all part of just what's the first line of defense, as you're saying.
Well, and what's that coordination look like? Because you have two regulators, the PCOB and the SEC, with overlapping jurisdiction when it comes to public issuer auditors. How do they coordinate that? Because what hasn't happened for a decade was the same action being charged by both agencies, and that recently has taken place. So it seems like there's a little difference in approach there. Any context you can put on that? Because at the end of the day, the practitioners out here have to deal with their clients and saying, well, wait a minute, why am I going to get whacked by both regulators for the same type of conduct?
Sure, and I'd say there's no bright line test. There really isn't. Depending on who is already in, we do coordinate, we do talk. We're not trying to duplicate efforts, but there are times when we're both there. We've both invested considerable time and effort, and we feel like either there's a message that could be sent by both of us taking action, or there are different remedies that we each can pursue, and that's something definitely always on my mind when I'm conducting an investigation is what ultimately could we do at the end of the investigation? Is this something unique? And that comes in the criminal context too. Like, what are we doing? What can we add here? But I like some of the things. I think scope, focus. Is the PCAOB looking broadly at 20 audits, and we're really focused on one particular one, and this was a really, really bad lapse. Things like that, timing, all of those are factors that we'd consider. But it's not, there's no, now, of course, we're all going to be, all in on every case. I think that's still probably the exception and not the rule.
Okay. Let's switch to our last topic of the day, unless we come up with something new on the fly, which is certification, CEO, CFO certifications, clawbacks. And Pravin and I were just speaking right before the panel, and I thought what you were talking about with the Department of Justice, I think some interesting perspectives as we're thinking about some of the different impacts and how we advise our clients around 302 certs and 304 clawbacks.
Sure. Steve and I were talking about the 304 clawback. As everyone knows, it's a way to claw back incentive compensation from CEOs, CFOs, where there's been a restatement of misconduct. Okay, that's sort of a level setting right there. And the recent SEC rule, the 10D1 that just came into earlier this year, that expanded it. That expanded it beyond the CEO, CFO, went to current and former employees, and made it almost a no-fault rule. It didn't really matter whether it was a big R restatement, little R restatement, or there's misconduct, and you could get the excess of incentive compensation. Someone who looks at both the SEC side as well as the criminal side, Steve and I were talking about the DOJ pilot program in terms of clawback, and I thought that was interesting. I'm not sure that will ever happen, just strictly in the SEC world, but the DOJ pilot program is where the DOJ finds that there is fraud, and the company still has to pay a fine, but then sets up a reserve. And then the company goes and claws back as much as it can from the employees that were involved in the misconduct, and whatever they maximize and get that clawback, they can get an offset against the fine with the DOJ. So if you have clients or you're consulting with companies that are in the worst of all cases, they're dealing with the SEC and the DOJ at the same time, those are possible strategic considerations. You're in a bad spot if both agencies are going after your clients, but looking at the various clawback options and how to permutate them to the advantage of your client could be helpful.
Just to kind of tie this to the conversation we were having earlier today about the remediation, right? So if you're having a scenario where you're trying to get cooperation credit, you're in a situation where you have a restatement and you have current executives, part of that conversation that you're having internally at the company, as well as with your counsel, and probably counsel for the executives if they have their own, do we have a clawback policy? How are we implementing it? And if we don't have a clawback policy, are we proactively doing this calculation to determine whether or not we can proactively, as part of our conversation and dialogue with our regulators, to say, we understand that this is going to apply, and we've proactively decided that he or she is going to pay back whatever amount. And so I think if you have that dialogue internally, that's something where hopefully you can demonstrate some proactive remedial measures to be able to hopefully gain some benefit from maybe not having to have that conversation again with the SEC.
How are you guys thinking about there's a lot of litigation risk around SOX 304. Just what does it mean to be misconduct? Is that scienter-based fraud? Is that negligence? Is it something else? And then also, what happens when the charged conduct actually has nothing to do with the CEO or the CFO? And then also, finally, third issue is it limited to incentive-based compensation, the fraud delta, or is it more than that? Is it everything that this person received in the whatever restatement period? How do you guys think about those litigation risks?
We're calculating everything, right?
Yeah.
Like we're figuring all of that out, and I think there's always, I think it's who's misconduct, right? That's always going to be, the question, and what positions you might take, and how is that going to impact any class action, any defenses that you might have. So I think it's definitely something that is always part of the equation, hopefully earlier rather than later when you're starting to think about, well, we have a restatement, now what?
And I think companies, especially with the 10D1 and even the DOJ pilot program, where it can expand to former executives. That's where I think the dynamics and the chance for litigation could be much worse. If you have the CEO, CFO, they're still there, they're part of the organization, a clawback has to happen. That's part and parcel of the restatement. But if it's a former employee, I think there's a much greater likelihood, especially with the new rules that are in place, for increased litigation between the company, and it'll be tougher to get the former employees, I think, to play ball in this and do it so willingly because it's out of their pocket.
Yeah. I mean, what's your, now I just feel like I'm moderating.
Please, you want to swap chairs?
I'm so curious. Well, what's your take on, I feel like the commission is all about taking on litigation risk. I mean, before, I feel like you tell me. I feel like a couple years back, the attitude was almost, well, if it's not settled law, let's just not go out there and create bad law. Whereas now I feel like if it's unsettled law, let's go out there, which I don't think is a bad position to take at all. What's your take on in SOX 304 land? Are they willing to go for it?
It depends on the case. It really, really, in that circumstance, depends on the case. If it's something where we really do feel like SOX 304 is easy. I mean, really, when it comes down to it, SOX 304 is easy. There's a fairly bright line. There's a lot of cases out there more recently, I think, maybe than in the past, even though it's been around for 20 years, but that establish when we're going to seek the clawbacks. And I think we've been doing it more regularly, probably in the last couple years. New rules, that's kind of not a question for enforcement because we come in after there's a little bit of history. So that I can't predict, but and on litigation, I wouldn't say that we're being more cavalier about it, but definitely thoughtful. And if it is something that we think pretty strongly needs action, we're not afraid to litigate. And I don't know that that's ever really been the case, but I think we're empowered to, if we need to, we're not going to back down.
Yeah, I mean, I was pleasantly surprised by my former office, the San Francisco office, bringing a standalone litigated 17A3 case against a CFO. This was a failure to disclose a warranty-related liability. And what's interesting, I could see a standalone 17A2, 17A3 where you have some alleged benefit, but here there was just nothing. The allegations all stem from the CFO was overseeing his team, who was basically preparing the accounting analysis, and he knew of some fact and just didn't correct them in the moment. And then, problems ensued. So I wonder, do you think we can expect more negligence-based litigations in the space?
I think because it's in litigation right now, I'm going to refrain from commenting.
Fair enough.
And that's
but nice try.
Well, look, we're coming down to the last minute of our time here, so I just want to take a minute and say thank you to the panel for all the time you spent getting ready, and for you, because I know that you're burning it pretty hot right now bringing cases, but appreciate the time, and hopefully everybody had a chance to get some perspectives as we're advising our clients. So, thank you.